All right, good morning, gentlemen. This is Clueless A Trading Frank. Welcome to a beautiful Sunday morning here out on the East Coast. Happy Father's Day to all of you that apply. And it is June 19th, 2016. This session is being recorded and will be uploaded to the Clueless A Trading YouTube channel. Reminder that you should visit the YouTube channel and just put in your email as a subscriber, so you're notified at any given time when I post video casts, very important ones, and you can review them on real time. Full disclosure, this is purely for financial education and not for any solicitation or advice. This is a Clueless A Trading introductory coaching session where we're going to cover the basics of the trading website, technical patterns, a bit of behavioral finance, and most importantly, go over a few of Clueless A Trading charts so you guys have a slight leg up as you enter the markets on Monday in understanding and trying to read in between the lines of what the signals are saying in the charts that I draw. Keep in mind that learning as well as understanding my work is a ongoing process, and it's not something that one can master in one day. Once you're comfortable a bit with what I'm going to explain and go and the charts, then I highly suggest, very strongly suggest, that you sign up for the advanced coaching session, which Marcus has already done, and you too should do also. Advanced coaching sessions are held on Sunday evenings, sometimes on a flexible time on Saturdays early, or Sunday early. So basically on the weekends. Extremely important that people go through those because they start to get a real idea of what is going on in the markets. So let's kick off first and foremost with a little with a quick walkthrough with what my service is all about. Most importantly, the Clueless A Trading service is designed as a very efficient tool for you to help you with your trading and your investing. We do primarily swing and day trades in day trading, with a special emphasis on understanding the broader markets. The platform that all the content is delivered in is the Clueless A Trading RT, that's for real time, private Twitter feed, all trade alerts, charts, comments, and some extremely helpful articles from my top picks of my own reading are put out there. You need to basically have that handy at all times, and many people don't realize that at any given time you can go into your settings and put your phone number and your cell number in there for mobile notifications. You can go into settings, you go down here where it says email mobile notifications, you click that, and you can basically put in your phone number, and you'll be notified at every single time that anything is put out there. We have David who have joined us right now. And David, can you identify yourself, please? Can you hear us, and can you see the screens? David, you need to identify yourself. I think I can find who you are, but you need to basically just bear with me 1 second, guys. Oh, it's David Tran. Okay, yep, that's great. Sorry about that. Okay. David, can you see the screens as well as hear the audio? The first part of the session that the first couple of minutes that you missed, you can always review back on the recording. So going back to what I was talking about, the Twitter feed is extremely critical because that's where all my content is delivered. The chat room that is available, the mobile chat, is purely for discussion purposes. But most importantly, one of the key features of my service is that I try as much as possible on a real-time basis to engage with my members. That is something which I'm sure all of you appreciate, and it's not that I can answer every single question every single minute, but the engagement is critical because in volatile markets, or any markets for that matter, where things are moving in a fluid fashion, up and down, the fact that I'm engaged with my members real time during market hours, and sometimes a little bit after market hours, I think is a huge, huge benefit. So you have the Twitter feed, you have the chat room, then you have the Clueless Day Trading channel. Yes, the Clueless Day Trading YouTube channel. All my video casts are, the free ones, are posted here. Some of them will show private, and because those are the private advanced coaching sessions, which some of you have paid a little bit of money to attend. So sometimes I distribute them on a public basis, but most of the times they will remain private. So you can see tons of video casts. You can pick any date that you want. You might want to look at a certain time, give or take a day or two during a major problematic date in the market, and say, hey, let me hear what Clueless Day Trading was doing at that time. Feel free to do that. There are tons of them, and you can basically just go ahead and listen to them. These things, which are, this for example is a private, it's got a lock sign. This coaching session, which I charge a minimal basic, I think it comes to like $40-some a session, which is a joke. I always say I pay my dog walker, more than that to take our dogs out, when we're busy. But the reality is they're not money makers for me. They're simply there for others, for Clueless Day Trading members to really get on the advanced stage to understand it. As you can see here, this session ran 2 hours and 31 minutes. This is 1 hour and 36 minutes. This is 1 hour and 34 minutes. So in effect, you're not paying for an hour. You're actually paying. You're paying for an hour, but you're getting more than 2 hours sometimes of serious coaching. This one went 2 hours and 42 minutes because once we get into it, it gets really involved. Okay, so the ones which are locked, you obviously can view, but I can release them at one point. In fact, I might do a couple of release some of them as a public thing because they've been there 3 months ago, for example, this one. And then, of course, you can listen to the ones which are free. Okay, so you have the Twitter feed, you have the chat room, then you have this, and that, and those are the main conduits or pipelines where I deliver my content. Real simple. Then we come into the members website. Okay, so here is your website, and there's a couple of things you might want to look into this. You have a chat room here where you can see, where we have the public chat room. We also have an administrative room where some important website related notices are put there. We have a trading room for members where traders are encouraged to go out there and put their own trades or trade related issues out there. So I encourage all of you, when you have time, when you're in the chat room, to go ahead and do that. Then we have the trading news brief, which is an important chat room because this one I put, and traders can put it too, it's accessible to you, very important analysis, which I don't want to clog up the main public chat room with these type of analysis that I put on there. This is from Fly on the Wall, and these are helpful. These are very, very helpful. This is the FOMC, Federal Open Market Committee analysis, quick one that you can read. All kinds of stuff in there. All right. So it's important that time to time, and I notify people as much as I can in the public chat room that I've posted something in the trading news. I call it the trading newsroom or the trading news briefs chat room to put in there. It is not necessarily for, it is not for chat. It is really for to put longer analytical articles, analytical pieces in there. Finally, we have the biotech booth, which will be filling up more often. There is a trader who has been busy for the last couple of months. He's still a very valuable member. Terrific guy, knows a lot about biotech, and he used to basically handle this room. And but I tend to just add things that that matter. It is not fully updated, but the biotech booth is there for the section of the trading universe that we trade in, which are the biotech stocks. So if there's something important, FDA breaks, things like that, you can always post it in the trading news briefs or in the biotech booth. So these are the 5 chat rooms that are there. The members public chat room is obviously the most active, and keep in mind that we have 150, sometimes a little bit more active members at any given time, but obviously very few can join on a full-time basis in the chat rooms. But that's that's where we are. It's critical, the members public chat room, because I do, like I said, I engage there on a intraday basis and try to put in my 2 cents, which are going to be helpful for you both on the trading side as well as on the motivational side, and keep people calm. Because remember, markets can make people dance like monkeys on a hot tin roof, and they can get very scary. We all know that. Okay, so another quick walkthrough without getting too much into it. On top of the menu, you have a couple of things that you should explore at your own time. You have a little bio on me, who I am. I'm a very private person. I don't like to go out there and flash my credentials out there, but a little bit of idea of who I am and what I've done and how this site came about is right there. Okay. Then you have the members area. Now the members area is something which is helpful. It is in a process of development, and you can see a bunch of things in there which are helpful. For example, this is where you sign up for your advanced coaching sessions. You click that, and it walks you through these sessions here. Don't take everything at face value. The bottom line is that you don't need to pick an exact specific date and stuff. Like I told you before, this was designed a while ago. So my weekend sessions are for the advanced group sessions, and for individual sessions, if anyone wants to really get in really deep on their individual situations and what they are trying to get out of it, then of course I do them on weekends. I'm sorry, on weekdays after the market. So it's really as simple as that. You have a free sample coaching session for beginner traders. You have a sample coaching session for advanced coaching. And then you have this little box here that you can click and see a few things here. You have a introductory, this is important, an introductory video on reading the algorithmic high frequency trading charts, which are offered on the Quad platform. So it's right there. You can click that, listen to this video analysis. This is the site navigation video, which walks you through how to navigate the site. Similar thing that we're doing here, but more in detail. This is going to get updated shortly, the long-term portfolio. The chart section basically fills up the charts. That is also going to be updated shortly, because we are in the process of doing version 2 of this website. So this has lagged a bit, as in looking back and finding charts from, let's say, from the last couple of months on a specific date, on a specific stock and things like that. You have the real-time Twitter feed, you know that. The trade performance also needs to get updated, and these are the basic trade performance on trades that we put out there on the option side, including on the price side. Okay, so I don't run a daily tally on every single thing because at this point I don't have the manpower to do it. But most importantly, I don't want to get into the game of having somebody track every single position, because at any given time I'm an active pro trader. I might not be in that position or sell that position. I do try to let people know that they have to manage their own trades, but I also let them know at any given time which position I'm completely out of. Being a flexibility is key. You have to manage your own trades, and depending on the P&L that you're running, your profit and losses, you have to determine where to get in. I mean, how much money you need to take off the table. But during heavy market inflection points, whether it be on the upside or the downside, I do tell people very clearly that you need to take your profits or you need to get in there and go long heavy. So those things are certainly notified. It's just that on a blow-by-blow account, not every single trade that we're in, I have the parameters put in there. You have to determine where you need to stay or go. Remember, I do not know, and I do not want to know what size money you're trading, how many options, how many calls you're buying, how many contracts you're buying on the calls and puts, how many shares you're buying. So I don't know what your profit levels are. Remember, somebody with the $800 profit and somebody with the $8,000 profit on the same percentage mover is going to think differently and act differently. That's common sense. Okay, the glossary of frequently used terms basically explains to you acronyms that I use. MYOT, for example, manage your own trades. BGT, behavioral game theory. PGT, which is predictive game theory. Terms that I use in shorthand in my daily content delivery. On the right-hand side, you have also some very interesting video casts that I put out there on specific things. Clueless commentary. This is a very important video cast I put out there on April 30th. And you can basically see all this stuff. You can use the live indices for quick reference on certain things. Posting calendar. I try to do about 2, if not 3, powerful visual video casts every week. And sometimes they get delayed a little. Summer's a little difficult time, but that's what, that's what the goal is. This is a very, I think, from a behavioral standpoint, a very important piece that you guys should read about the resolutions and mottos from December 31st of 2015. Okay, so that sums it up. All right, you have you have a behind you obviously is my workstation, and there's a lot of stuff going on there, right? I call it Command Central. So there we go. Is that what I just explained in the last few minutes? Is that understandable to all? Okay, great. Remember, we are not, one of the things that and this I'm going to mention right now, 1 second. Let me get these things out. Okay. All right. So one of the things I want to explain is, look, what I do here is unscripted. In other words, I'm not reading off a script. This is not like one of those big services or other services, which is like, telling you, and I've mentioned, as you know, I've spoken to each of you on a personal basis, and I've explained my philosophy on what I'm trying to do. So this is not some scripted service where you're reading off a teleprompter, okay? This is something coming straight out on what I'm thinking, what I'm doing. Now keep in mind that I have years of accumulated information and experience in my head. I have taken losses years ago that you all put together cannot even count, believe me. And I've made 10 times more back. Because this game is not about how much you lose, it's how much you make. You're not going to lose every day. But net, over a period of time, you can, if you're winning more than losing, you're going way ahead. So saying all that, don't expect some cookie cutter language coming out where you can, where you expect me to, just sound like every other service out there telling you there's a method of doing this and a method of doing that. All I know is that I have worked on what works for me, and that's what I share with everyone. And it's obviously worked very well, because otherwise I wouldn't be sitting here and you guys wouldn't be listening to me. If you look on StockTwits, there are close to, I think, 24,000, or I don't count, followers out there, and I don't even post that much there. I just post a couple of tactical market charts and sometimes individual stock charts, and that's it. Saying all that, here is my suggestion. Keep in mind, I don't advise. I am not your financial broker or your advisor. Okay? I suggest you take my suggestions, you use your own determination, and then you move forward. Okay? Very, very simple to understand. I am not responsible for your P&L. I am responsible to deliver the content which I think is strategic enough to help you navigate these very, very difficult and volatile markets. I don't care. The market is always difficult, whether it's running off to the upside that everyone's missing, or if it's running down to the downside that everyone is so scared of that they're even scared of shorting. It happens all the time. Because the machines that run the market, the algorithmic high-frequency trading machines, are designed to confuse you on both sides. They will never make it easy. The easiest points in the market where the easy money is made are the most difficult on a mental standpoint for traders to get in. Primarily when the markets are on a free fall and creating some sort of tradable bottom, as we saw recently, as we saw in October 2015 during the flash crash, where the Dow Jones dropped, where the Dow Jones dropped 1,000 points in the morning and then reversed. So this is where the easy money is made, okay? And this is where nobody buys. You don't hear it from the gurus in the media, in other forums. You don't hear it from anyone. All they keep on telling you that it's over. This is where the easy money is made. No one knows whether markets are going to travel all the way up here and just, I mean, these are phenomenal moves. But this is where the easy money is made. Within the next 24 to 48 hours, you get some serious returns on your money. And we try to identify them using many different technical indicators, specifically on the internal side. The simplest one to use is the stochastics, which you're going to touch on base level today. And I've shown on all my charts. You can look back in hindsight, like they say, when you look back, everything's 20/20. Hey, I should have done that. I could have done that. Most of them is like, I could have done that. It's a could have, should have scenario. But while the action is going on, everyone's frozen stiff. And it's natural. But trading and investing is not about your human emotions being natural. You have to break that mold. You have to be robotic. You have to think like an algo or a machine. That's what I try to do. That's what I try to teach. That's what I try to motivate people to do. And the rewards are enormous. If you go with your regular human emotions during extreme volatility, whether it be at the bottom here, whether it be at these tops here, okay, then you'll never make it. You have to go outside the boundaries of normal human thought. There's an old thing that people tell you, right? When if you go to your BMW dealer and just picking a name, and he's got these M6 high performance 600 horsepower cars, right? At a sale, 40% off. Would you not buy it? Would you not lease one? Sure you would. You get money from anywhere to do that if you're a car enthusiast. The market goes off on 40, 60% sales, individual indices, for example, the energy sector down 60%, individual stocks down 40%, 50%, nobody wants to touch it. Whoa. You know? So you have to think outside because it's different. You know, physical goods, people just run whenever there's a major sale going on because there's an intrinsic value to that good. That M6 high performance, Bimmer has intrinsic value and the pleasure of driving it. But the stock, which is down 40%, there's a major intrinsic value on many different metrics. In other words, maybe it's trading at book value. Maybe it's trading at a discount to its PEG, which is price to earnings growth ratio, not PE. PE is a bloated thing. Forget about PEs, okay? Per price to earnings. A lot of them say, oh, PE is this. Well, in growth companies, you got to look at PEG, price to earnings growth. These things I teach during advanced coaching session. Whatever the case may be, they may be trading at a 40% discount to that or 30% discount, yet no one touches it. That's the difference between intangibles, which are the stock market, financial markets, and physical market, what we deal with. All right. So the bottom line is the three aspects to this business. It is obviously understanding the background of what's going on, this being the S&P 500, for example, so you're less scared during volatile times. No one's saying not to be nervous. No one's saying don't be stressed. I am. There's a famous book that was written, which is one of the hallmarks of American tech revolution, by Andy Grove, the Hungarian immigrant who was one of the founders of Intel. It says the paranoid never sleep. Only the paranoid survive. My apologies. So be paranoid, be scared, but use that as positive energy, not as negative energy. I tell myself that every single day. In every crisis, there is opportunity. And in some of the worst days in the market, okay, some of the worst days in the market, we have made significant money. Case in point, just this week. Look at this reversal candle. Lord help us. You could have made more, and I'm sure some of you did too, than you would have made in a month just by playing this candle. Every candle is money, up or down. So you have to know what you're looking at. And all these different lines, what they're doing here. Can add more indicators. The vortex indicator, what that's doing. A second. Okay. You can keep on adding a lot of stuff, okay? You can keep on adding, and this is just on freestockcharts.com. Imagine what you can do on Thinkorswim and other places. So lots of different things that you can add, but everything is trying to tell you a story. Just by looking at that, I can make a good high probability bet. Remember, trading and investing is a game of probabilities. It's not a game of certainties. It's human nature to try to get into things which they're certain on. In investing, that is completely deadly for your own profit P&L. If you have to measure the probability of a risk reward. If you want certainty, you're going to pay a lot more for that price. I didn't say that. Warren Buffett said that. And it's true. Certainty means that, okay, this stock is definitively going higher. By that time, the stock is higher. So you got to pay more for it. So if you want certainty, get ready to pay a lot more for the price of that asset. If you make a measured bet based on many different probabilities, technical analysis is one of them. Of course, there's also fundamental analysis. Then you can then you make the most money. That's where you get the biggest bang for your buck. It doesn't mean you always have to be contrarian. It doesn't mean that you always have to say, oh, CNBC is saying the market's really crappy, so I'm going to buy it. No. You have to make a measured move based on what you're seeing in patterns and stuff. That is my goal at Clueless Ape Trading, to constantly evolve and make systems, these type of technical systems, better with a fundamental knowledge of what's going on around you, so that you all can benefit, and I'm certainly learning every day. Okay? So Did that, all that I've said so far before we get into the charts and how to read my chart and stuff like that, make sense? People who have audio, please say, I mean, with a microphone, say yes. People who don't, then just go ahead and, and we'll leave the last part of the session for question and answers, which I'm certainly here to do for you all.
Yep.
Excellent. Excellent. Good. So now we're going to get into how I try to do these things. Somebody once told me, some member who's already there, because, Frank, I love the Clue to Say trading service for a simple thing. You don't seem to hide everything there and tell you there's a method and and people are left in the dark. They just have to follow you blindly. Never follow anyone blindly. Okay? That's the purpose of these things. I don't open my whole book and say, okay, this is what I'm looking at. I'm looking, honestly speaking, on a given day on my 12 monitors in total. I am looking at possibly 40 different things within 2 seconds with a glance. My brain is processing the information plus the news flow that's coming out on the front side to make a determination of what I think is going on with the markets. Okay? So, but I still show the sort of the inner workings of what I'm looking at on the chart wise, so you all can be one step forward. So there's nothing to really hide here. The only thing that I can't really explain are the intangibles, the gut feeling, as we call it, of knowing what might happen. And I could be wrong, but I'm not majorly wrong. It's very hard to call the market a buy when things are down 400 points. But so many different things I'm looking at, I process that, and then I say, go ahead. And that's where huge money is made, repeatedly. Don't need to be aggressive. In fact, that's the time to be really aggressive and put a lot in. Do I always do it? No, because I don't know what's going to happen in the next 25 minutes. Because the machines can basically come in and just dump a huge sell programs out there. But those are the times you can actually really get in deep, hard. But do a little bit at a time. Once you build your confidence, I asked one of you the other day, what's the biggest trade? What can you inject in yourself that can be your biggest trade going forward? Confidence. How does confidence come? Confidence comes not by listening to my lovely voice on a Sunday morning. Confidence comes because, excuse my French, New York style, you made a shitload of money on a trade or a couple of trades. Your confidence is so frigging high that those next couple of trades that you do, you have a high probability bet that you're going to win. Because everything you're seeing, your amygdala, that's the part of your brain which basically provides you with the firepower that you need to do what you need. Risk-taking, decision-making. Look it up, amygdala, okay? I use that word a lot. Tells you, I can do it. You don't go into a trade saying, oh, what's my downside? You go into a trade saying, how much can I make off this frigging trade? So that's what your octane or your super premium gas, okay, rocket fuel that you need, race gas as we call it when we go to the tracks with the cars, right? So that's what you need. So in order to do that, the build up to that confidence is, of course, preparation. That's part of this. All right. So let's go over what I do on the chart. Oh, let's go over patterns. So real simple ones. All right. So I'm going to scroll through this. Actually, go here because most of them are. So pattern recognition is key. Understanding what certain patterns do is critical, and it's not a one-day process. So we can do this in one session. So one of the more simpler patterns that we look at, for example, are, there's a lot of complex patterns here, are This is one. It's a very powerful one. It's an inverse head and shoulder. I've showed that many times on my charts, okay? This is what an inverse head and shoulder look like. At your own time, please go to this website, surinotes.com. It's up there. And do it. Inverse head and shoulders are happening quite often, especially when markets fall apart. This is when traders completely, just lose it. So you have a left shoulder. I showed this just recently in the market. In fact, we have an inverse head and shoulders going on. Hopefully it holds on the S&P right now. Now, it's not always as defined as this one. The right shoulder could be lower, throwing people off. But that's something, my job to try to explain and your job to try to learn. So you have a big drop off here. This is what the markets do, right? Large drop off here. You create a head, a move up. It goes up to the neckline, moves down. Everyone freaks out. That's also known as a consolidation pattern channel right here, profit taking. Then it moves up again, attacks the neckline. Whether it breaks above the neckline, we don't know. We use Fibonacci retracements, as this gentleman has done, to see how far it can go. There's a gap fill here. So these gaps get filled. Gaps always get filled. Don't ask me why. At what time frame they do on the upside or downside, that all depends on market volatility. But gaps get filled. And so here you have the left shoulder, the right shoulder. Then you have another version of that, inverse head and shoulder. Oh, he's showing different sort of, pictures of the same thing. But this is a very powerful pattern, very powerful. Now, the reverse of that is head and shoulders, which happens a lot in the market. We might have a broader head and shoulder in the market. I'm talking short term, what's going on with the inverse head and shoulders. So here you have a head, you have a left shoulder, a right shoulder, and then you have a break of the neckline, come and retest this gap here, possibly a floor, and then it bounces up. What happens after this? We see. Now, if you wait for these patterns to develop, you're not going to make money. You have to be a little bit predictive, analytical, and that's what I try to do. Because by the time these patterns are formed, let's say you're shorting, and you're trying to short here, you're just going to lose money because the market's going to move up and create the right shoulder. By that time, if you are completely ignorant on these type of things, you're going to sell your short, say, oh my God, the market's going up against me. And right then, the market collapses. And you say like, oh shit, I could have made 100% on those puts and I got out. Now, the movement of these type of things, even intraday, are exasperated and enhanced by volatility. Volatility is created by high-frequency trading machines and, of course, human emotions at play. Remember, the retail trader does not control the market. And the retail investor is not really existent in the market, believe it or not. The average involvement of mom and pop in the market has dropped to a low of almost 40%, if not less. And that's mostly through mutual funds. It's the machines which are driving the market. So it's extremely critical that you try to understand what goes on here. But I do the hard work of doing all that analysis. Your job is to look at it and say and tell yourself whether or not it makes sense or not. And if it makes sense, you have to take a position. Here's head and shoulders again. Then you have the dragon formations. Extremely important. Extremely important. I've made a lot for myself and for others using the dragon bullish formation and all this stuff. There are many different types of dragon bullish. Dragon bullish is similar to a inverse head and shoulders, except the left shoulder, or the leg he calls it, leg one, is lower. It doesn't look like a shoulder. It looks like it's more of a W pattern, right? Almost like a double bottom. But it's not, because it doesn't get to it goes lower than that. So to me, it's a combination of a double or triple bottom, except and the inverse head and shoulders pattern. You have a head here, calls it leg 2. Okay, head here, left shoulder, right shoulder. Like I said, if the shoulders get pushed down, it looks like everything's going to hell in a handbasket. But this is what happens. Now, how does one figure out what will happen? We're going to get into that. That's the internal reading. Remember one thing about charts, is I like to remind everyone. Okay, let me get my drawing tool here. Here you have something called externals. Can somebody tell me what externals are? Or take a guess. When you're looking at a chart, what is the external side of that? Nope. News is not the answer. I'm talking about technical analysis here. News is not what we're talking about here. So when you're looking at a chart, what are you looking at, the externals or or price movement? Yes, who said that? Who said externals are price movements? Good job, Marcus. All right, good. Absolutely. Externals are price movements. Second question. What do traders primarily look at? Can somebody please answer? What do traders primarily look at, or investors? Correct. Who said PE? Completely wrong. And that's why you're going to be one of my best students, Will. Okay? Forget looking at PEs. PEs mean crap when you want to make real money in the market. I know it. I worked in the money management business on the highest levels. PEs are great to analyze companies over a longer term. Okay? PEs will make you pee, all right? So forget that old line of thinking for now. This is the new paradigm. So it's good you mentioned that. So PEs are important, of course. You know, if the market's trading at a PE of 8, you buy with hands down. Market's trading at a PE of 20 plus, which is price to earnings. Of course, you know, you start to get wary. We're talking about technicals here. So externals are price movements, and somebody said that, okay, so what do traders primarily look at? They look at just the prices. Is it wrong? Not at all. In the old days, before the advent and the introduction of high-frequency trading machines and algorithmic programs and all this funky stuff, which are here to stay, by the way, price and volume was all that mattered. Price and volume. Old legacy or old-fashioned technical analysts always say, all you got to look at price and volume. Bullshit. Okay? Because this volume does not always manifest itself on the front side. Can somebody tell me why? The volume on a particular stock is not always reflected on the charts that you and me look at. Does anyone have an idea why? Who said dark pools? Marcus knows. You're absolutely correct. Dark pools and private exchanges. Okay, I'm going to call dark pools DP. And like they say, if you see a dark pool on your summer vacations, don't jump into it, all right? You're going to disappear in the black hole. Dark pools, and I'm going to say PE, private exchanges, PEX. A significant amount of large cap stocks are traded within the dark pools, and you can look up the definition on Investopedia and stuff, okay? And where large investment banks basically are, and hedge funds are trading in a private market away from the view of the external public markets. That's why volume is not always reflective of price and volume. But volume is important. Where can we see the true volume of what is happening in the markets? On what asset class? Someone take a guess and tell me that you can actually see the true volume. No dark pools, no private exchanges. Take a guess. I show it all. The hint is I show it all the time. And I say that you need to monitor that for directional movements intraday as well as going forward. Anyone take a guess? No? Anyone? Okay. On the futures markets. On the futures markets, you can actually monitor. You can actually monitor what's happening without having that volume masked by dark pools and private exchanges. As far as I know, yes, thank you, Lloyd. You're correct. As far as I know, futures are not traded in dark pools and stuff. They're traded off the exchanges, and it's a good indication. That's another day's topic. The futures, reading the E-minis and the TF, which is the Russell futures, and sometimes the NQs, the NQF, which is the NASDAQ, is so critical to your P&L and stuff. And that's more advanced stuff. That I get into it real deep in the advanced coaching sessions. To me, it's second nature to look to see what's happening on the futures markets while we're doing what we're doing on the front side. So for now, that's a little bit too advanced for a lot of beginners, but you'll get there, okay? When you sign up for the sessions, we'll get into it. Believe me, you're going to see a different world out there. It's just like a deep sea diver looks at it from a different perspective, and you put me in deep sea diving, I've done some basic ones, snorkeling and stuff. I haven't gone like deep sea diving. I'd need a diaper. How about that, okay? So it's a different world. But once you see it, it's there. Yes, Lloyd is correct. It is generally a leading indicator, but at the same time, extremely volatile. And the patterns that manifest itself on that side. Okay, so price to volume. So volume is not always, as we just explained, is not always key. So the price is basically started. More 99% of traders are just looking at price, all pricing. Wrong, because if you're going to make a real predictive bet on what is going to happen over the next hour, 2 hours, whatever the case may be, prices are manipulated by these algo HFT machines with no fundamental basis why they're moving up or down. They're just doing it. Why? Because hedge funds, which are employing a good number of these machines, okay, programs, have an unfair advantage over the retail trader or even the pro traders. Mutual funds hate algorithmic high-frequency trading machines because they move around prices for no reason. They do all kinds of stuff which is borderline illegal. Not to say there's no benefit from it. These high-frequency trading allows liquidity, movements, and stuff like that. Keeps the prices, commission costs down, things like that. But still, there's a lot of negatives. So because of that, your price will just go like this and just drive you nuts, while there could be positive news on the stock or all kinds of stuff. So traders just don't get it. They can't figure out why Amazon will fall 20 bucks in one day for no news, and the next day it'll be up 30. What they're doing is, the hedge funds are doing, I'm going to call it HF, the really active ones, and there are many different types of hedge funds, as you know, different strategies. But the really active ones are total bandits. They're day trading. They're day trading the markets. They're picking a few number of stocks certain days, running them up, running them down, So they're day trading. We're going to call it DT. So if they're day trading the price movements intraday, sometimes in like a few minutes, how many times have you seen stocks great news pop up, pop down, and by mid-afternoon, boom, they're up another $6, especially the big cap stocks. And you're like, what the hell? That's the new reality. So get used to it. It'll take time. So they're day trading. So prices remain extremely volatile. So what it brings us to is to understand try to read the tea leaves by the internals. I always put a simple analogy, which I've mentioned in all my sessions, okay? It's like going to a doctor. And the doctor looks, and you're sick, you're sniffling, and you look like crap. So the doctor looks at you and says, oh boy, you look really bad. You're like, oh yeah. The doctor knows, he's looking at your externals. And he knows by physical visual that you're not well. He doesn't know your internals till he runs a series of blood tests, does all kinds of, maybe does the EKG to see if you have heart issues, all kinds of stuff. I don't know. Doctors know all that stuff, right? So he does a lot of internal tests on you, blood tests, etc., to find out what is really going on within you. That is the same thing with reading the internals. And if you can manage to understand the internals to a certain degree, then you will be able to manage the outside. Then the doctor can give you a full diagnosis and what medication is required for you to get better. That's what the internals are. To me, internals are key. Why? Because it's benefited me. And I've shared that with people. Want them to look at certain things. How many times has the markets opened down 150 points? I keep on talking about resets, resets, resets. You think I just make up that word? These are internal resets that are going on. And right at the point where it's deep oversold or the stows are turning, whatever the case may be, the market turns. Yes or no? Have you guys, just in the short period that you've been with the Clueless Aid Trading Service, have you not seen examples of resets and then overbought conditions where I put that red arrow and say, that's it, they're going to pull the market back down at that point? Yes or no? Have you guys seen them on my charts? Okay, what about the others? Lloyd just said yes. No one else has? Marcos, I'm sure you have. Okay, good answer. Seen but not understood yet. So we're going to go over that today. Good. Very easy to understand. The basic version is very easy to understand. And that's one thing we're going to accomplish today. So internals are extremely key. Other chart patterns. Let's move on. So this dragon bullish formation is very serious stuff. Okay? And whenever you start to see that, you better start to get bullish. Even though it's on the external side. But if the internals start match, let's say deep oversold conditions, match with what we're seeing here, you're going to see a blast. It's happened a lot. Just did it with Priceline just over the last 2 weeks, while nobody was even looking at it. Did it with a bunch of drug stocks recently. Biotechs are more difficult to trade because we're very, very news driven. So yes, patterns manifest themselves, but they also change very quickly. Dragon Bull. At your own time, look at these. Then the other one that comes into play, well, we covered head and shoulders. We covered this dragon bullish. What is the cup and handle? The cup and handle is serious stuff. And traders get all crazy about this. Cup and handle is just what it is. It's a cup and a handle. Get a nice big cappuccino cup or whatever, big flat bottom. This is a handle. And then it goes. Now what it is that you have a large basing period on a stock. Okay, what the stock is basically just kind of moving around these levels, creates a slow moving up. And people who are smart and looked at the internals, which justified buying this, maybe they were oversold and started to see it getting, starting to move up. They were buying at these levels. They're going to take profits. The ignorant, non-technical guy will come in and start buying here because he's like, oh, price is moving up. This is a breakout. It's going back to its previous high. Well, guess what happens? Boom. It goes into a consolidation channel. I'm going to call it CC. So it goes into a consolidation channel. Simply means there's profit taking. Because if I bought this thing here at 2 and it's at 6 here, I'm not going to look at a gift horse in the mouth. I'm going to take some profits. Maybe I'm, like I say all the time, a lot of the time, I'm taking 80% of my trading profits off the table. 80% sold. You've seen those on my thing. Even on a short-term basis. This could be, this is more of a longer-term pattern. It doesn't happen in one day. So it's reaching the previous highs. and there's resistance. Maybe some, does anyone understand the definition of, very important, of resistance and support? In fact, understand the definition of resistance. Okay, what is resistance in actual human terms? Why do stocks have a certain resistance? We all know resistance is like a wall, and either it breaks out or the wall basically makes it come down. We understand that. Can anyone give me a quick answer to why it happens? Because remember, charts are nothing but manifestations of human emotions, right? So what do you think resistance is? Look at this chart. I'll give you an example because we want to, resistance is fear to buy. Yes, that's one example. Not really, but that's one consequence of that. What resistance is, let's say, for example, you bought this stock here or here, okay? And the thing plummeted. So it was like, let's say $6 here, and you go all the way down to 2. You're still holding on. You're like, oh my God, this is crazy. I'm finished. My grandma's going to kill me. She gave me this money and I blew it. And then the stock starts to climb back up. Maybe you add a little bit more. Most probably not. That's what most, idiotic lack of buyers is a consequence of it. I'm explaining to you the reason behind it. Yes. Lloyd said lack of buyers. That's why I was answering to that. So it kind of climbs up, and first thing that goes through your head, and this traders do all the time. Oh my God, I'm even. I'm taking my money out. Right? I know it's right. That is what's called primary resistance. The stock got back to a level where the majority of the people had bought it. So given the fact that they were down maybe 50% on it, and now they're even, right? They're like, that's it. God's given me a chance to get out with all the money that I had. Grandma's still going to, invite me over for Christmas dinner. And you sell. So you sell. So what happens is smart guys who bought it around here, they're selling here because they're taking some nice profits. And the other guys who are just break even, I'm going to call it BE, break even, right? They're selling too. So it creates a nice consolidation channel. And the dumb ones who bought here, necessarily, not dumb ones, let's say some smart ones who are expecting the stock to break out because it's getting to that level, breakout level. BE is, I'm going to call it break even, BEV, and breakout, we're going to call it BE. Okay, so they do that. They're like, oh my God, if they don't understand technical analysis, there are copper handles known as the C and H. Okay, they start bailing out with a loss. Now, consolidation channels in certain formations are powerful. A cup and handle is one of the most powerful formations you'll get, like the inverse head and shoulder, like the dragon bullish formations, or dragon bearish for that matter. So this is the time to get it. Now, how do you monitor whether it's going to break out or is it going to break down? You look to see how this consolidation is going on the external side, but most importantly, you look to see whether this consolidation is creating a oversold condition on the internal side. And if it's creating an oversold condition on the internal side and that consolidation channel is holding tight, it's going to break out. But it needs to get oversold. Here it got overbought. It needs to get oversold. Negative sign. Once you get oversold and it creates a consolidation pattern, bam, it's gone without you. So resistance is really a factor of where the stock meets a lot of supply, okay? A lot of selling. Markets hit resistance at certain levels, and all kinds of stuff. So one factor I gave you, the human factor, is that, you break even, you're like, okay, I'm out of Dodge. So if you know how this pattern works, you'd be buying here. Even after you get break even, then you win. So resistance is both technical and mental. Support levels are just what they are, support. At that point, the stock from a fundamental basis might be again, using PE or PEG, it's discounted, heavy sellers have gotten out at that point, and it creates an exhaustion, selling exhaustion. So it creates a level of support. One reason. Shorts are covering. Maybe somebody shorted at 6 and they covered at 2. All kinds of stuff happening. So support. Let's move on. All that made sense? Good. There's a lot of different ways to look at things, but I like to look at the human factor first. That's what matters. So there are many different patterns of technical, thing here, couple handle low. This is the classic couple handle low, using the Fibonacci retracements. And this guy's a serious technical guy, okay? Like I refer to him. Suri Dadella, he's an Indian gentleman. He's on StockTwits too. He's a serious technician, written books and stuff and everything. So anyway, so he's showing all this stuff, the breakout level, which is known as the neckline. I love cup and handles. Shown a lot of big money makers on cup and handles too. So here's another one. Sometimes it's this. Let me show you. Okay? Sometimes it goes like this. A move sideways. Keeps on doing this. That's a consolidation channel also. And then either breaks down or breaks up. All right? So generally breaks out. If it's consolidating like that, that's when buyers and sellers are fighting each other and creating a nice trading. What do we call this? Does anyone know what this is called? In trading, what's it called? I know you guys. Yes, a channel or range trading. And a range trading can last for weeks in the case of the markets, and people get all confused. So that brings me to my next point. Everyone in the back of their head wants to get a big breakout, or if they're short or want cheaper prices, they want a big breakdown. Ladies and gentlemen, I got news for you, for gentlemen in this case, okay? Or others who are listening, so ladies and gentlemen. It doesn't work like that a lot. We don't need to get massive breakouts and breakdowns. You can do a channel trade, which would be a wide channel. The S&P, in my opinion, are moving between 100 points. Now, 100 S&P points is roughly about 600 to 700 Dow points. That's really what the Dow's moving in. The Dow's moving either on the upside, 18,000, on the mid-level, 17,500, and on the low end, 17,000. Or 17,200 actually. So that's roughly what the S&P is trading too. I'll show you on the charts, if you look at a broad band, that's what the S&P, it's a very wide range trading situation going on. Now, we are humans. We're not trading with millions and billions of dollars, at least on the trading side. Okay? So range trading can become a little bit unnerving. You can make a lot of money in between the ranges. So that's what it is. Channels and range trading. I'm going to call it RTR, or range trading channel, whatever the case may be. All right, let's move on to the next pattern that we see and I show. The wedge, or the megaphone, is a pattern that I show. Oh, here's the channel. There you go. We're talking about all kinds of lower channel, rectangle channel. Good stuff on this side. Okay, so you got to see it. I mean, you got to keep it as a reference point all the time. All kinds of different channels. Not much to see here. Okay, where's the wedge thing? It's triangles. There are certain things in here I don't even understand. So Now, triangles are difficult patterns, okay? I've shown them. You start to see a narrowing of the trading band, and then you see a breakout. So not much to really explain here. This is just how triangles are formed. Now, within the triangles, there could be multiple patterns. You could call this a well, this is actually a symmetrical triangle. There are ascending triangles which look like this, which I love a lot. Okay, prices are moving higher like this, and everyone's like, oh my God, we're going to crash. Maybe it slips a little bit, gets back in there, and ascending triangles based on the internals can break out big. It happened with S&P 500. I have my chart calling this line the ascending triangle. Okay, that's called the ascending triangle. It gets narrower and narrower. It's like really nervous time, this and that. This is also can be a rising wedge, and that's what I was looking for. A rising wedge looks like this, and I show this all the time. A rising wedge falls, creates a consolidation channel. Prices go like this, gets narrower and narrower, fewer and fewer buyers, and then it has this consolidation. Profit takers come in, push it down, and then if the market does want to go higher and the internals justify it, it breaks out. And this is where traders completely freak out because they just don't get it. They're like, oh my God, this is it. This is the end of it. All it's simply doing is basically creating what it's doing is it's all about oversold and overbought conditions. So what it's doing is it's resetting the overbought conditions. Here it got overbought. I'm going to call it OB. And here it got oversold based on the internals. So if you look at the stochastics at this point, stochastics would be up here. And at this point on this oversold condition, they would be down here. And we're going to get into that in the next 5 minutes. That's the simplest thing you're going to use every single day looking at my charts, and you figure out what you need to do. All right, so at this point, it is a buy. At this point on these overbought levels, when most people are excited, they're like, oh, market's going higher, or like, oh, I'm making money. So it's good to be excited, but you got to keep an eye on this stuff. Up here, it's up here. And that's a rising wedge known as the RW. I'm going to call it RW. What's a falling wedge? A falling wedge is a bullish pattern because this is a minor bearish pattern, right? Because it pulls back and this prices go like this. Traders are freaking out again because they just don't know how low things are going to go. Internals are again back to oversold conditions, deep oversold conditions, which I have written down on my charts, yes? I also use the McClellan oscillator to show that. You've all seen that, yes? I need a response, please. That's why we need headsets and microphones. Okay, good. You get a falling wedge like that, it is powerful. Falling wedges, macro falling wedges as I like to call them, on large cap stocks are the biggest money makers. Yes, you might buy here and suffer a little bit more down. In my case, I average cost down, and then it just goes bang. And that's when everyone starts chasing it. By the time I start changing it, this probably gets up here and creates a consolidation channel. And they freak out. Oh my God, it's going down again. All it's doing this. You can also call it a cup and handle. Funny how these things happen, but these are the laws of nature. This is how it works. Now, behind all these technical patterns, I'll just touch it briefly, is human emotions. Human emotions. And that is exactly why these things do what they do. When human emotions get to a point where it becomes devastatingly despair is the point of maximum return or the point of buying. Overall, the market sentiment over the years is really of complete apathy and despair. Yet the markets have climbed from 666 on the S&P 500 to where we closed at 2071 and higher. But no one's happy because no one really made money. As traders, what do we care? This is a capitalist system. You got to look after your own pockets, and then you got to do the good things in life that you need to do, like give to charity, help other people, do what you need to do. But first and foremost, you have to make, excuse my friends, shitloads of money. And then comes the rest of the stuff. So what the masses did by sitting around in a bunker, in a cave, is not our business. And in fact, the more pessimistic the overall sentiment is, the better off we are. And we have been seeing that since 2009. Now, it doesn't mean we're not going to get big corrective pullbacks, right? But that doesn't, it's certainly not, you need to take advantage of that. How about that? So let's talk about bear flags and bull flags quickly. These are bull flags, okay? This is sorry, let's start off with first the bear flag. Bear flag is this, where you have a stock, it keeps on going higher, and I've been caught in a bear flag too. You don't know whether this is going to break out or break down. That's a bear flag. What happens is shorts cover here, interested buyers start coming in here, but if you're not looking at the internals, it's basically you don't know how to read this. You think this is going to break out because it's starting to form a price pattern which looks like it's going higher, and then before you know it, it falls. That's a bear flag. Bear flags occur a lot during downtrending bear markets. Fake breakouts, as we like to call it, and such. All right, simple. So you have a bear flag. Next move is this. They suck you in, a bull trap. All right, here's a bull flag. I like bull flags from higher levels, like this. That's a real bull flag. Okay, that's a real bull flag. Everyone's like, oh, it's too overbought. That's a bull flag. Okay, stocks which have exhibited massive bull flag patterns. Alta Salon. Giving one example. Amazon. All right. Many other stocks. Not that many, but power stocks. Keeps on going higher. That's a bull flag too. I like this type of bull flag, but these are good, fine, and good too. I actually like these ones too because they're coming off some very deep oversold levels. One of the things I like to look at is not chase stocks with like making new highs all the time, which is good for high momentum stocks. But if the momentum in the market is changing, the market sentiment is changing, high momentum stocks are the ones which get hit the most, right? We know that. So coming off the deep oversold levels, that's one of my primary reasons why I picked up Priceline, and it went up $65 in 3 days. Calls went from $4 to $84. I am not kidding you. All right? That's a confidence trade. That's a confidence trade. You'd be so confident your next couple of trades would be winners regardless of the market or anything. So get used to it. Here's a bull flag 2 coming off a massive oversold condition. You can look at this as an inverse head and shoulder, this creating the right shoulder, this creating the left shoulder, and in the meantime, it's a consolidation channel and a bull flag. A bull flag and a consolidation channel are pretty much the same things. Here's the breakout. All right, so that's one. Very important. We see this all the time. Flags. Megaphone. Now, this is something I show. These are difficult patterns for regular people to understand, even technical guys, because, it carries a bit of, you take a little bit of what we say in English, you take a little bit of liberty in drawing in patterns, right? Look at this. If you just looked at this pattern, you're like, oh, it's a megaphone. Well, I've drawn megaphones which have worked. But if you look at the naked eye, you're like, oh, look at that price pattern. This thing's definitely going lower. But megaphones, if many points touch, at least, 2 or 3 points, work. Depends. Megaphones work mostly on indices, on the S&P 500, Russell 2000, and things of that sort. This gentleman brilliantly shows many different patterns of the megaphone. These I like a lot. You creating a double bottom. I showed that recently. I think I showed that recently on Chipotle. You guys create a double bottom, left shoulder, right shoulder, breakout, and believe me, megaphones are sick. You know why they are? Because what's the upper end of the megaphone? Holy cow. Grandma is going to say, my grandson turned out to be a fine kid, right? Exactly. Powerful, powerful. And they happen. They happen. They don't happen too often. But when you catch one of these megaphones, offset this type of massive reversal handle, inverted hammer, then you start to really feel good about yourself. All right, enough of this. This is another great site which explains more. Flag and Pennant. Investopedia is basically the encyclopedia of anything to do with finance. Great site. They've improved a lot over the years. Falling Wedge. This is what I told you. Triple tops and bottoms. Triple tops scare the living daylights out of traders because when they hit that, they're like, oh my God. Triple bottom, love it. Cup and rounding bottom, great. And all other stuff is there. All right, let's move this out of picture. So we don't have like 9 hours here to sit and explain every single thing, but let's look at a couple of important charts that I put across. This one, let's say, before I go any further, it is extremely important that all of you use at least one platform, one or two platforms that I'm using, so you can match the charts. If you're using something, and I was talking to one of you guys the other day, and I said, you know what, you don't need to trade to Thinkorswim, but at least put in a little bit of money and get access to their website. I mean, to their trading platform, so you can track the charts. I used Thinkorswim. I remember years ago, for 3-4 years, I didn't trade one single stock on it. I just used it for learning charting because it's phenomenal. But then there are the free ones. So I use 3 different platforms. I'm going to show you this quickly. This is freestockcharts.com, which you can basically also pay for. It's run by Warden. Great system. I use the free one. I also have the paid one. Then you have Thinkorswim, which is really like driving a Ferrari. Okay? You got to know what you're doing. And believe me, it sends out signals like beauty. All right? Then you have this, which is tradingview.com, which is also very easy on the eye. And a lot of people use tradingview.com. So we got tradingview.com, we got Thinkorswim, we have freestockcharts.com, and then we have, where's my Twitter thing? 1 second. And then I use one of the most advanced systems out there, which you all should use after you get a little used to my charts and all that stuff, is Quad Algo HFT. Phenomenal. Every single bar, you can really drive, it's literally like driving a serious high performance car, because if you don't know how to drive it, you're going to wrap yourself around the tree. Okay? Try getting it behind the wheels of a Lamborghini Aventador. Okay? You start that engine, you hit the gas, you're done. You're either on the pavement upside down or your thing. You got to know what you're doing. But first, you get used to some of this other stuff. Okay, so just remember that. Let me just get the Twitter feed out. And I'm going to pause for a quick second as we get into the next leg of this, and just ask everyone, is all this at the time that I'm spending, is this making sense? And you think that you are starting to learn? Okay, that's a plus. Yes, in regards to charts and patterns, that's basically the focus of this thing. And it's just the basic introductory stuff that's going on, okay? But covering quite a bit. Yes. Marcus? DT? David Tran? Good. All right. I'm not going to get into this because I just love this thing here, okay? This particular thing, and it's not just the charts, everything I draw on top of it, because that's a critical component of charting, how you frame it. When I'm calling these markets at these bottoms here, and I'm saying there's that this looks like it's going to stick. Now remember, in hindsight, it's easy to see. Oh yeah, you bought it here, and there was a big reversal candle. It's not like that during the daytime, because this candle didn't just develop on its own, and this candle almost went red. But I'm watching the internals on these, and then I'm using my gut feeling. I'm processing information that's coming out on the background, what the overall sentiment in the market is. And then I'm making a determination. This one went up, and then anyone who waited around for this candle to develop lost money because it went down. But if they held and dollar cost average and saw what was going on here and my post, they would be up a lot. This move from here to here on the 16th generated calls on the reversal candle. This was the morning, and I called it right there. 600% on your intraday money. I'm not kidding. It's there. See it? 600%. When was the last time you all made 600% or even 500% or 400% on real money? I'm not talking about making $100. Just think. So this is, again, all these beautiful patterns in August of 2015. Yeah, all luck. Well, no, you did it. Don't, you know. So what you have here is this going on. If you want to look at patterns, does this remind you of something that we just looked at? Oh, yeah, it does. An inverse head and shoulder is what really comes to mind. All these mathematical pivots and resistances and supports and some of the lines that I draw, also based on what I'm seeing here, these conditions developing both on the slow stows, which is starting to move up nicely. I like that. It gets over. This is where I'm going to explain the overbought, oversold conditions. So Marcus and everyone, please focus. So you have that. The measured move is 2086, 2088. That's why I keep on saying max move before Brexit is probably going to be around 2088. I called the other day the max move around 2080 based on this gap fill. This is a gap fill, which is written on my other charts. These dotted lines from here. In fact, it did fill the gap, but I just used it again. It's called the liberty of, you know, I'm taking a little bit of free reign on showing things, okay? So gap fill, hit the gap fill, bingo, sell. Right there. Let me do this, hold on. Let me get this line. This is exactly these patterns that we just discussed over the last half an hour. I put a big arrow here. If we break out over that, we're going to go up to 2100 right there. So let me get this thing here. So you got 1 point here, and I started putting markers, you know, these things. So we could come low. We could come down to 2060. Okay, it could come down. This could come down Monday morning to 2060, but this is the level we need to hold, which is around 2059, 2060. It could do this because it's a complex pattern with one head, which is defined at 2050, right? And multiple shoulders developing. Just the way, you know, here, multiple shoulders developing. So this shoulder can slip and slide a little bit. This is starting to get overbought, but who's to say this is not get oversold on Monday morning down here? And then make a run up for 2080. Believe me, these machines can play games with your head, which it does every single day. So let me explain in simple terms what overbought, oversold conditions are. When you see the stochastics, and this will show differently on freestockcharts.com than it'll show here. Freestockchart.com is a little bit more slower moving parameters. These are faster moving parameters. I use and by the way, the introductory session to understanding these algorithmic charts, as I showed you earlier on, is in the members area. Play the video and listen to it. So here, every time it gets this oversold, is nothing. The stochastics are simply the first derivative of relative strength index. Okay? Selling pressure and that type of stuff. In simple terms, this is where most people have sold. This is where most people have bought. So profit taking comes in. So on a longer term view, every time you start to see, or I'm sorry, even on a shorter term view, every time you start to see the stochastics coming down to the 0 level or below the 20, just like the RSI, you start to see whether or not it's a buying opportunity. Most of the times it is, even if it's for a short while. That is exactly what happened. Now the channels that I drew, it is exactly where it went, overshot a little bit, hit the gap, this gap, and then sold. What I'm saying now is that we will probably fill this gap, hit some resistance. Either we'll fill this gap here and then possibly pull back. We could pull back to 2065. That's roughly 100 points on the Dow once we hit this. And markets have been doing that a lot. You noticed? You just ramp up. We make some money fast in the morning if you're actively trading, and then it starts to pull back, and then it decides to do what it needs to do after 2 p.m. But these charts are giving me some powerful signals on what I think might be going on. Now, when you have large-scale selling like this, when you see a candle of this magnitude, all bets are off. That's why I said we're going to open down. Expect a bad Thursday open. Wednesday open, I believe I said that the other day. And I was right. Because the size of this candle didn't justify a move up. And a lot of it is like Will said, part of it is luck. Luck is a major factor, but luck is preparation and knowledge and hard work. So this was a very lucky thing. Puts just exploded. We sold. They went from $5.50 to $30. Most of us, I issued the sell signal in, I said, sell at the open, 18, 20 plus, and then they went to $30. Yeah, I missed the last leg of that, but hey, $5, $7 to 20 plus. Hey, I'm not looking at a gift horse in the mouth. Yeah, you can leave a little bit of the runners out there. It hit the lows, issued a buy signal, and that's when it just reversed. Then it pulled back, created, see this little lines here? These are basically, it's a consolidation flag. How about that? Like I showed on the other side, this could be called a bull flag, right? I don't really want to call it a bull flag. I call it a consolidation flag. Let's call it CF, this line here. What it's doing is it's got overbought, and now it's starting to, it wanted to release some pressure. Profit taking came in, it came down here. Now what I'll be watching first thing before even the market opens is whether this line is going to be down here, oversold, in which case the markets will be pre-market showing negative tonight after 6 o'clock when futures start trading, or whether it's going to get overbought big time. Remember, it gets overbought like that, the chances are you're going to hit 2080. S&P futures will open up maybe 9 points, 5 points, 6 points, 7 points, whatever, higher. And if you're a tactical trader and you have a decent number of calls, S&P calls or SPY calls, you want to take profits. Yes, it might overshoot all the way to 2086, but if you have nice profits, you take it and leave a little bit in there. My opinion is this pattern, as I have been showing for the last couple of minutes, does get completed. At this point, we are going to hit some major resistance. The Bollingers help me determine how things are going. The lines that I draw are very crucial for everyone to have an idea where they stand. And if we break out over 2090, then the next level of major resistance comes in around the 2100 level here. There is a big gap here, which is filled around 2110, 2117. Oh boy, that could very well happen if Brexit doesn't happen, in my opinion. In my opinion, like I said it on one of my charts, I showed it. This is the Brexit no vote. In other words, Britain remains within the EU, sorry. So this is Brexit negative. In other words, they stay. Brexit, as you know, is Britain exit. And if Brexit does happen, we're going to come and test 2040 real fast. So that's going to be a drop of from 2070. You're looking at a drop of about 200 Dow points. It's really as simple as that. And 2040 is a major support. We'll see from there. So looking at overbought, oversold condition, when you see the stochastics, the fast stochastics, which move faster, obviously, up here, you might want to, you should consider taking profits if you had bought these tactical lows based on my alerts. If the slow stochastics get really overbought, they can stay overbought in a strong market, as you could see, as the market kept on climbing back in the early part of June. But one way or the other, the markets cannot stay overbought to that degree, and that's why you had this big, nice fallout. Then we had a pullout, and now we are going through it again. So by the time, if markets hit 2080 or 2086, let's say another 100 points from here on the Dow Jones, this will be up here. It's really as simple as that. Just keep it simple for now. All right, understood? I need response from each of you. Marcus, EMA trader, Mr. Tran, DT. Okay, good. So we show this thing here, and these lines, you're going to get used to it. This is a nice bull flag coming off a lower pattern. So these drawing and stuff, you guys will be able to do it too, but it'll, once you do this, and let's say in a few weeks you take those advanced coaching sessions, you'll be able to draw your own lines. I'm sure you do too. And be more accurate than I am. So this is another one. I love this one. This was at what time? This was June 17th. What time was it? I thought it'd give me the time. Hold on. Okay, 2:52 p.m. Good. 3 o'clock. So this is a great chart to understand. So let's walk through this, okay? You got a lot of things going on here. You got a channel. This is the channel, right? The channel. These are lines that I draw. So you can just take a naked chart and not understand it, but I frame it within a context so you guys can start to understand it. So I like this one a lot because it's double bottom. Define double bottom. While everyone's freaking out thinking we're going to, just melt and stuff, it bounced off the bottom, which is a good thing. Otherwise, it would be at the lower end of the channel, which would be around the 2040 level. I don't think we're there yet. So at this point, things got oversold. So it triggered also a buy. This I like a lot. It triggered a buy on the slow stochastics. The slow stochastics are very important because they're really for swing traders. So it gives you more power that this thing's going to work out despite intraday volatility. Everyone understand that? What I just said? Short term, you might get volatility, but what this is telling you that if this crossover continues and starts to go this way, then by the end of the week, the markets are going to be higher. Generally, that's what it's telling you, despite the fact that you get intraday volatility. Did everyone understand what I just said? Okay. I don't want to remember one thing. This is the first session. You're not expected to understand everything. Just understand the basics and then go from there. Don't overthink this stuff. You're not a rocket scientist. And you're never going to be like a robotic technician. You're just going to be somebody who can understand and interpret my work in a way that will benefit you. Just remember that. And if you go in with that type of attitude, you're going to win. If you want to be a PhD in technical analysis, well, in that case, you're not going to be a great trader. Simple. Keep it simple, all right? KISS principle. So here you got oversold, and these stows, if they turn and move up, then this market will basically hit the same levels that I mentioned to you, which is the 209, 208.87, 209 level. These are the sell points here. Now, what is the bullish version? The bullish version is the market does this. There's a big gap here at that 2100 level, right? Big gap. And there are multiple patterns in here with the head, Inverse head and shoulders. This is it. Left shoulder, right shoulder, slightly lower. Bounce off that, which I like. A breakout over this, possibly gets here, moves down a little bit, and then makes a move up here. This is a strong possibility going into the end of next week. Because if Brexit goes no, we're going back to 211 SPYs and 2100 plus on the S&P. Just on the initial burst. What do you do at this point? Keep on buying? Absolutely not. You sell. Yes, you might see an overshoot, but smart money is going to be selling at this point because they know that even if we want to go higher, they're going to create a consolidation channel because this can also be looked on as a very large cup and handle. Yes? Yes. And that consolidation might bring us back down towards this breakout level here. That's another day story, testing breakouts. And then moves from here higher. If the market is really juiced up to move higher, you're going to see you're seeing the old highs on the S&P, which I believe was 213, 214, right? On the SPYs. I know on the S&P it was 2134. So that's the bullish scenario. But every time you get these consolidation little moves, don't freak out. Just wear a diaper, okay? How about that? Just don't freak out and do stupid things. What's the bearish? What's the bearish thing? The bearish thing is we held this. We try to go, move up a little bit. Big sell zone here. And then move fast and furious down here. That's the bearish view. It's still within the channel. But if you consistently remain long after we break below the, let's say, 205.5 level or so, and I'll be monitoring and alerting people on that, then you are going to get hurt badly. Or if you get caught in that downdraft, then you want a dollar cost average down here at around 2030, 2040, or 203.40 on the SPYs. Because from here, we could very well get one of this. If this is a downtrending channel, let's say this is a downtrending channel, fine, you can still make money off these bounces, big money. Maybe the market wants to just keep on going like this till it hits 2000 S&P. In the meantime, this is a 1 hour chart, meaning that it's a 1 hour, the parameters of the 1 hour view. I'm going to be watching these levels fast. Okay? So that's enough for this one. I'm going to show you now on the, let's get this out. freestockchart.com. So let's see what's going on here. A lot of stuff is going on. I'm looking at short term because right now Brexit, man, you got to think long term. What if they do decide to vote? You're going to see a nice crap in the market fast. So the part of the things that if you're monitoring my Twitter service, that the latest polls are showing that that the Remain camp is winning, which is a good thing. So here you have a lot of stuff going on, same stuff. You got multiple shoulders. Here's your head. So if you take this pattern from here, I always look to see patterns from levels of interest. Levels of interest are supports right here. So let's say this pattern, zigzag, zigzag, drives everybody nuts, right? But look how the pattern is developing. Move up here, moved really sharp move up here, came down and tested again the left shoulder, which is at that 2045 level, 2049. Now this left shoulder can reverse itself. You see the moving averages, and that's what I want to get into right now. So this pattern can either manifest itself on testing the upper end of the, back test the channel here, back test the lower end of the channel, or it can completely crap and come down to 2020, which is a major support for the S&P 500. 2020 from here is 400 points on the Dow. You don't want to be long on that drop. Okay, just letting you know. So when you look at my charts on the free stocks, the thing that you'll be watching for, that you'll be monitoring, is you're going to look at the moving averages. I use the 50-34 and I use the 5. All right, the 5 is, and then I use VWAP, but I'm not going to get into that right now. And you start to and then of course I have the moving average 200, the 100, just to see, how it's all playing out. Bottom line is the 50 and the 34 are what really is, in my opinion, important. This is a bullish pattern developing. I'm focusing on this move right now on a short-term basis, which is this right there. All right. Upper end of that is 2088, matches on all fronts, on the algo HFT front, on this front too. That also coincides with the retest of the 100-day moving average, but also a breakout above the 50-day moving average, 2084. That's on the hourly chart. Short term, that's what I'm watching. Either it's back to 2050. This is the box. Sometimes I put these box charts. Or it's going to move up, and this is your sell zone. Is it possible that this pattern, which I showed before, sorry, let me draw this right. Is it possible that this large pattern probably come down and retest the top of the box, that this gets completed? Yeah, very possible. That's on a Brexit, favorable Brexit. In other words, the UK remains within the EU. I think we get up there. And this pattern could very well work out. Huge. Your calls in the S&Ps, 400%, easy. But the markets are never going to make it easy. The machines are never going to say, oh, yeah, we're definitely going to go up there. That's where the signal reading comes in. So you're going to watch these moving averages, the patterns which are developing. And of course, you don't need, all you got to do is read my charts and try to figure out what to do and not do stupid things. Like I said, have diapers ready, okay? So is that a dragon? Not really. Okay, there could be a dragon on the longer term front. 1 second. Let me look at the 4-hour charts, which I look at too. That was a very large consolidation. 1 second. Freezes once in a while. That's the problem with free stocks. It runs on something called Silverlight, Microsoft Silverlight, so it tends to do that. This was a very large consolidation channel that I kept on showing, and it worked out. So this is, in my opinion, no dragon bullish here. Okay, it is simply doing nice consolidation, breakout, come down, retest these moving averages, and now try to reclaim them back. That's what I'm going to get into next, and we're going to start wrapping up. So you have the 34-day moving average at 2090. This is the 4-hour chart. You have the 50-day moving average in red at around 2080. In order to reclaim those back, we need to at least get above the 34-day moving average. That's still a lot of money, because the buy signal in S&P was triggered off at around 2050 and 2070 on Friday. So if this goes like this, there's going to be resistance here at the 34. If that holds, then we have room to move higher. This is as close to a daily chart that you can get. Now, let's look at the internals. So when you look at my chart, the things you'll be looking at is the 50-day moving average, the 34-day moving average, the 5-day moving average, which I'm not sure why it's not showing up here. One second. It's the yellow line that I use. Okay, it showed up now. So the 5-day moving average on the 4-hour is still kind of pointing down. On the 1 hour, because remember, that's your trader's friend. You know, some people use the 4 EMA, like 4 EMA Trader does. You can use the 5. I use 5 because there are 5 trading days in the week. Okay? And let's do the hourly. And if you look at the hourly, the 5-day is starting to keep it, just feel it this way. It's pushing up these candles. First level of engagement on the 1 hour. That's the first thing you look at when Monday morning, is whether or not we are at 2085. Because once we hit this moving average at 2085, there is going to be resistance. But in my opinion, my gut feeling tells me, with the fact that different news factors, with the fact that the polls are showing that Britain's Remain camp is now in the lead, it's possible that this move here at least gets up towards this level. It's possible. It has to break above the 50-day moving average. Or if this 34-day moving average, which is still pointing downwards, okay, we're still in a downtrend on the 1 hour, moves down, the first level of support comes in here. You can see that. That's where we reversed. And the second level of support comes in at 2050. We'll see. But this is a good possibility that it comes up and tests the back end of this rising. These are uptrend channels, right? We broke below those. So is it possible that it tests the back end of the uptrend channel around 2090? Absolutely. There's no way of telling what's going to happen. I'm just telling you what the probabilities are on this front. All right. So those are the things that you watch. Now, I like the fact that the yellow line is starting to move up, and I'd like to see it start to do this type of thing. Now, if you notice one thing here, and pattern symmetry recognition is key, and it's not something you can develop in one day, but you should start doing it. If you look at this move here, if you look at this here, this pattern of these lows, doesn't it not look like this? This was a downtrend. Yes? No? Yes? No? So pattern symmetry. I'm not saying it's going to happen. I don't know. Okay? I'm just saying you got to take these things into account. This is almost ditto to this. Inverse head and shoulders. Head. Multiple left shoulders. Right shoulder. Left shoulder. Right shoulder. Maybe another little drop down here to create a third right shoulder. Just the way it did here. And then a breakout. Is it possible? And I showed this, and we played this one, by the way. Is it possible it does this? Yeah. And I showed you what the bearish move would be. All right? Yeah, looks similar. So it's called pattern symmetry. It doesn't mean that it's going to exactly the way it happened, but pattern symmetries work. I've shown pattern symmetries. People cannot believe that they work until it happened. But till it happened, it's too late. Can't make money. Got to be a little bit forward. So looking at this stuff here, keep an eye on, we're going to start wrapping up. Okay, keep an eye on the stochastics. Stochastics not overbought yet on the hourly. I also zoom back very quickly to see what's happening on the swing trade side. I like this a lot. This is telling me we are just starting to climb out of this oversold thing. Can it possible that we can do a double dip? Absolutely. But one way or the other, this will need to get overbought. The vortex indicator, look up the definition on that, is quite overbought at this level. Every time it gets up here on the vortex indicator, it has a reversal. The red line needs to start to come down. What I like is it's hitting overbought levels, but look at the green line. The vortex indicator, positive vortex indicator is starting to move up. Good sign. Kopak, don't worry about that right now. Okay? So that's your free stock charts, the way you're going to look at things. You want to don't use this for intraday trading, okay? Because they don't move as fast as Thinkorswim or not. Looking at Thinkorswim now. This is the larger picture of what's going on. I've shown this chart many, many times. This is the E-minis. Let me put the S&P in there. This was the downtrend breakout. This was the downtrend line, okay? That's what's point. If somebody was waiting for the real breakout, that would be here. We were buying all the way down here and here. Uptrend line was broken at 2091. That's exactly what the numbers are all pointing to, 2091. Because even in a downtrending market, you want to do a retest and fail and then come down. Maybe it comes down like this. The Darvas box is basically a trading range box. Use it. Put it on your Thinkorswim chart or any other platforms that you use. Okay, the Darvas box gives you an idea what range we're trading in. We're trading on the daily between a range of 2050 and 2125. If you want to look at it that way, okay? Right here, down here, made it halfway there, but let the Darvas point out what is going. Right now, the Darvas is showing, these are automatically generated by the algo. So I'm in Thinkorswim, so it's not me. The Darvas is showing 2120, low of 2050. That's a 400-point type of move on the Dow, back and forth. It is, markets are oversold. We are seeing some pressure on the, we're seeing some pressure on the 50 and 34 and the 50-day moving average, which is not necessarily good on the daily charts. In other words, the actual bull trend on the market might be broken. Okay, so if these lines start to cross down, I mentioned this in my previous videos, okay? If these lines on the daily start to go like this, oh, you're coming in for a real sharp fall in the markets. Not in one day, but over a period of days. Till things, you know, so I'm watching this 50 and the 34-day moving average, which I use a lot, converge like this, like you're seeing here. Now, is the convergence going to go point down? We don't know yet. Or is it going to kind of move, keep on moving sideways and tilt up a little bit? We want it to be in a trajectory where it's moving up. But right now, there's pressure on there because these sells in the market were heavy duty pressure. And these were a couple of hedge funds blowing up, all kinds of stuff happening, big money flowing into government bonds, pushing yields down, money coming out of the stock market. Big hedge fund blew up on Friday called Visium. I'll post that news in this weekend. Read it. I'm sure they had a lot of Amazons and Googles and stuff. Google and stuff and Amazon don't fall like that for fun. They fell because that hedge fund was forced to liquidate because the guy was doing all kinds of funky stuff. Anyway, so that's number one. Number two is look at the Darvis. Look at this is on Thinkorswim. These white lines are the Bollinger Bands. They're still pointing up. That's a good sign. Hold on. This is okay for now. I drew it like this, so it's still moving up. You can double dip, but it's moving up. McClellan oscillator is what I'm going to finish with today. Okay, the McClellan oscillator is starting to show a positive divergence, regardless of the fact that the markets were barely up on Friday. So this is a good sign. Once the McClellan oscillator goes into overbought territory or even has the first bar, you would have made significant profits if you were a buyer at these levels. End of story. If the McClellan oscillators do these type of rapid movement on the histograms like this and gets up to 153, you made a lot of money and you better get out of Dodge. In other words, sell. Best buying opportunities are McClellan oscillator around here. Okay, which we almost got to, but not there, which is the minus 200 level, which we saw here. What did the market do from here? Made a monster move that the majority missed on, as I like to keep on saying. Monster move from here. So this is a very useful indicator. Very useful. All right. So right now we are getting up there. We need to push up, and this needs to keep on shrinking. Everyone understood that? Yes, good. Just keep it simple for now, okay? So you can see, because all these tools, yeah, they're just fantastic. They're just fantastic because they help you manage your things. You don't lose your head all the time just looking at prices. We covered that before, and we move on. This one I show once in a while. This one is the TradingView chart. TradingView is very nice because the ticks actually move very nicely and right now this line was drawn because there's a gap fill here. There's a lot of stuff going on here, so I'm not going to get into it now. But this was a bull flag that I called. The breakout over this consolidation channel, this blue line was a consolidation channel. It bounced exactly off the 50-day moving average. See that red line? It's beautiful trade, beautiful trade. I sound like Trump there. It was a beautiful trade. Okay, so all right, so now it's pulled back, fill this gap. I like it. Move up. The first level of resistance is going to be, again, 208.44. Anything above that would be the back test of this broken channel, and that would be around 210.90. In other words, 211. Ladies and gentlemen, we have covered a lot of stuff tonight. This session is recorded. You can re-listen to it. This is a basic session, how to start reading my charts. freestockcharts.com. Let's look at the daily. We looked at the daily, right? Oh, there's your daily. And the daily is still a mixed picture. We still have it downtrending, 5-day moving average, not good. But we are at that confluence point where I'm not asking for the moon. I'm just asking for a nice fat trade up to the 2090 level, and I am out of Dodge and looking at what to do next. This is starting to turn. We would like to see this line cross over, which would be very bullish on the daily if this crossed over like it did here. Okay? And most importantly, like it did above the 1800 level when everyone was basically looking for the next cave to get a reservation in, right? So right there, back in February. So that's good. We need to have it cross over. Then we have, I'm finishing off with this because I didn't do the daily. And then we have the vortex indicator. I'm liking this. This vortex is starting to, move up. 1 second. Get the drawing tool. This is still moving up. That means that there's still downside. But this is starting to curl up too. So that's good. That's good. I like that. Then we have the Kopach curve, which I'm not going to go into today. It's more of a long-term swing thing. And we have the MACD histograms and stuff, which are starting to show oversold condition. You see this blue line? That's the OBV, or on-balance volume, that many of you know about. The OBV pointing down showed how much money just came out of the market and got the market deeply oversold. And as I told you, it went all into the fixed income market, pushing yields lower in the German Bund, in the 10-year government bond. They're all hiding in that beautiful cave, what we call the Treasury Bond Index, which is at historically low levels on yields. In other words, when I post those charts and I write those things like this should be the point where the markets could find the bottom, look at them, known as the TNX. That's it. All right. Thank you for your support. All of you have joined as members after free trialing or not even finishing the free trial, and I appreciate that. I will do my best to help people, and I'm certainly committed to make sure that people understand all the nuances, technicalities, and all the games that the market plays on us. We are not geniuses. We are simply fast learners and fast movers. And you have to be flexible. Mental part, very hard to fathom. I'm still working on it, believe me. Otherwise, I'd be making $1 million a month, all right? So it doesn't work like that. We're trying our best. We live in a great nation, and I mean that. So when you hear a lot of garbage that's spewed out there, just take a step back and imagine if you were living in one of those countries that we are seeing every single day. People are dying because of things that are happening out there, all right? And we have had those kind of terrible things happen here too. But at the same time, it's not like you're walking out the door and you're getting shot. So remember all those things, keep a positive attitude, and win. That's all I got to say. Thank you for listening. Have a great weekend, and happy Father's Day to you guys too.